Today we'll explain how the UK's 14-year rule can affect inheritance tax planning, and why failed gifts may unexpectedly influence older transfers.
Imagine helping your daughter buy her first home with a generous £250,000 gift. You feel great about it. But when you pass away years later, your daughter receives a sudden $90,000 tax bill. And the trigger for that massive liability? A completely unrelated financial decision you made 14 years earlier. Here at Pro Tax Accountant, we specialize in helping high net worth individuals and entrepreneurs navigate hidden UK legislative traps exactly like this one. Most UK taxpayers rely on a baseline known as the 7-year rule. A direct gift to an individual is called a potentially exempt transfer. If you make the gift and survive for 7 full years, that money becomes completely tax-free. But this common knowledge turns into a dangerous snare the moment you mix outright gifts to individuals with complex transfers into trusts. Doing so activates a highly technical mechanism known as the 14-year shadow. Let's look at a taxpayer named Jeffrey. In 2012, he placed £300,000 into a trust. In 2019, he gave £250,000 to his daughter, and in 2026, Jeffrey passed away. Jeffrey's family felt completely secure. Looking at his timeline, exactly 7 years separated his trust transfer from his daughter's gift, and another 7 years separated the daughter's gift from his death. That spacing created a powerful illusion of tax immunity. The trap begins with how the law views that first transfer. Moving money into most trusts creates a chargeable lifetime transfer, a specific class of gift that interacts with HMRC rules quite differently than cash given to a family member. This animated timeline shows exactly how the statutory mechanics apply to Jeffrey's estate. After his death, the executor's first task is looking back exactly 7 years from 2026. Because Jeffrey's 2019 gift to his daughter falls inside this window, it legally fails and transforms into a chargeable transfer. Every UK resident has a basic tax-free allowance called the nil rate band, currently set at £325,000. Jeffrey's family assumed this allowance comfortably shields the daughter's £250,000 gift, resulting in zero tax. But here is the statutory trap. To calculate the tax on a failed gift, the law mandates a second 7-year look-back window. This one starts from the date the gift was made, in 2019, stretching back to 2012. And that sweeps the hidden £300,000 trust gift right back into the calculation. That older trust gift operates sequentially. It legally consumes the £325,000 nil rate band first, crushing the available tax-free allowance left for the daughter down to a mere £25,000. With only £25,000 protected, £225,000 of the daughter's gift is left completely exposed. Applying the standard 40% death rate tax to that unprotected amount triggers a massive £90,000 tax liability. Many people think taper relief will save them here, but they misunderstand the rule. Surviving 4 to 5 years after a gift reduces the tax rate percentage applied to the excess. It does absolutely nothing to reduce the core value of the gift sitting outside your allowance. The 14-year shadow is a blind, automatic mathematical mechanism. In this scenario, it legally forces a grieving family member, Jeffrey's daughter, to personally pay a heavy price for her father's forgotten financial sequence. We can solve this problem by changing a single variable. If Jeffrey had simply reversed the transactions, making the outright gift to his daughter before setting up the trust, the secondary look-back window hits empty space. The result is zero tax. This establishes a golden professional rule for wealth transfer. Always sequence your direct individual gifts before your trust transfers to actively protect your nil rate band. To execute this safely, your executors must unearth and report up to 14 years of flawless financial records on the required IHT 400 form. HMRC compliance is incredibly strict, and documentation is not optional. Navigating these historic timelines is becoming even more critical. Incoming 2026 and 2027 legislation introduces a strict £2.5 million cap on agricultural and business property reliefs and pulls unused pensions directly into taxable estates. The stakes for proper sequencing are rising rapidly. Families can proactively deploy tools like Gift Inter Vivos life insurance. This specialized policy specifically covers the tapering tax shortfall of lifetime gifts if you happen to pass away before the 7-year clock runs out. Please remember, this information is for educational purposes only. UK tax legislation is highly complex and requires specific professional analysis tailored to your unique financial situation. Estate planning cannot simply be a DIY project. If you have utilized trusts or made significant lifetime gifts, secure your legacy by contacting Pro Tax Accountant today for a bespoke strategic review.